Hello, this is Bob Steele. In this lecture, we will continue on Chapter 9. We're basically going to look at learning objective number 6, which is to prepare each of the budget schedules that make up the master budget. So, let's see. We have a sales budget. So first, what we're going to do is start with the sales budget because we need the sales budget in order to know how much we're going to produce. So we have to start with the sales budget. It does need to go in order in this way. So we have Breakers Incorporated is preparing budget for the quarter ending June 30th. Budget sales for the next 5 months are April 20,000, May 50, June 30, and July 25. And notice we're talking about units here. And then we have here the selling price is $10 per unit. So that being the case, we can take a look at April, May, and June, which would be the quarter, and then we'll have the quarter ended here, and we have the budgeted units that we had that we just came up with, 20, 50, and 30, coming up to 100 total. Multiply that, how much we're going to sell these things by, and I'm not sure exactly what we're making, something for breakers, something related to waves in this case, and these will be our revenue numbers. Okay, so we have the production budget. Now that we know what the sales are going to be, we can figure out how much we need to produce. So whatever the things we're making, we need to know how many of them we need to make. And in order to know how many we need to make, we first needed to know how much we believe that we would sell. So the management of Breakers Incorporated wants ending inventory to be equal to 20% of the following month's budgeted sales in units. So March 31st is 4,000 units were on hand. So what we're going to do is when we think about the ending inventory of the stuff that we're going to have on hand, we know how much we're going to sell. We also want to have a cushion because if the sales numbers are just an estimate, and if we happen to sell more than we budgeted to sell, we want to have some cushion in there so that we can cover that in that case if that happens. Okay, so in order to look at the production budget now, this is the production budget. We have the sales that we estimated in our sales budget, and we're going to add to that the desired ending inventory. So the desired ending inventory, according to our calculation, was the 50,000 units for May, the next month, times 20%, because that's how much we're going to want to be left over in ending inventory. So that's the 10,000. So how much do we need to have on hand for sure in order to meet our sales budget as well as the amount that we want to have on hand at the end of the period? The 20,000 sales plus the 10,000 we want on hand. That's how much we would need to produce if we didn't have anything in there at the beginning. But of course we do. We have inventory in there from last month. So therefore this is what we would have to produce if we had nothing in the warehouse already, but we already have 4,000 in the warehouse. Therefore the 30 minus the 4 is the 26. Those are the units of the things we need to produce for breakers. Okay, so then once we know that, then we can figure out how much we need to purchase, how much direct labor and overhead will also need to go into there. So we know how many things we're going to make. Now we're going to think about how much stuff we need to buy in order to make the things that we're going to make in order to sell the stuff that we projected that we are going to sell. So at breakers, 5 pounds of materials are required per unit of product. So management wants materials on hand at the end of the month equal to 10% of the following month's production. So when we buy the materials, whatever it is we need in order to make the thing we make, we want to have the same component. We want to have the same factor comes into play in that we want to make sure that if production goes over, that we have enough materials in order to cover that. Therefore, we're going to have another cushion in this case that we want to have some amount in ending inventory. Alright, so if we look at the materials budget then, it looks something like this. We got from the production, we had 26,000 units we're going to produce. We had to multiply that times however many units of material it takes to produce 1 unit, right? And that will give us our production need. So that's how many units of material that we would need to purchase if we were just to cover the sales that we projected to have. But we also want to have something in ending inventory. So this calculation here, 10% of the following month's production, 10% of production following months, is what we want in ending inventory because we want that cushion. Therefore, this number being the 130 plus the 23 being the 153 is the amount that we would have to purchase if we didn't have anything already in the warehouse in terms of material. But of course we do have something in the warehouse. So we already have $13,000 on the warehouse as of the beginning of the month. So therefore, we only need to purchase $140,000 here. So that's going to be similar calculation on the materials. We can then go to the direct labor. So once again, we figured out sales, and then we figured out how much stuff we need to produce. And now we went from materials, and now we can figure out how much labor it's going to take in order for us to meet the production needs. So at Breakers, each unit of product is 0.1 hours of direct labor hours. So the company has a no layoff policies, so all employers will be paid 40 hours of work each week. So that basically means we're going to have a bottom line. Even if production is under, we can't go under this 40 hours. So in exchange for the no layoff policy, workers agree to a wage rate of $8 per hour regardless of the hours worked. For the next 3 months, the direct labor workforce will be paid for a minimum of 3,000 hours. So let's see how this plays out here. So same type of calculation. We're going to have the production. These are how many we're going to make. And we said that it takes 0.1 hours per unit to make it. Therefore, we're going to have 2,600 is going to be our budget. Now, we said that there was a baseline that we said we're going to pay a minimum of 3,000. So if our production needs are under what we need to produce in terms of labor, if we need to have labor be 2.6 is what we need, but we have that bottom line number of 3,000, we're going to have to take the 3,000 and multiply that times the wage rate, and that will give us our 24,000. So on the other hand, in this month, we took the 46 times the 10%, and we're going to need times the 0.1 hours, and we're going to need 4,006 hours, and that is above the minimum of 3,000, and therefore we're going to take this number, the higher of the two, times our wage rate, which will give us the dollar amount, 36.8 for the month of May. Alright, so then we have the overhead budget, which the overhead budget is actually fairly more straightforward because many of those numbers are just going to have to be given to us, and they're probably going to be reliant on either the prior period, the prior month, or on projections from particular departments. So that would include indirect labor, indirect materials, utilities, rent, insurance, maintenance. Going to just give us those straight out numbers in order to fill those in for the period. Selling and administrative expenses. So at Breakers, variable selling and administrative costs are 50 cents per unit. Fixed selling and administrative costs are 70,000 per month. The 70,000 fixed expenses include 10,000 in depreciation expense that does not require a cash outflow for the month. Okay, so let's see how that breaks out. So selling and admin are more the period costs. There's a variable and a fixed portion here. The variable portion, remember, will change with the level of production or sales. So the sales units will be 20. The variable portion said it was 50 cents per unit. Therefore, we get the 10,000 variable portion. The fixed portion won't change. It's the same all the way through. If we add those three up, it comes out to 210. If we add up the 70 and the 10, we come out to 80 for the month of April. And then we're going to remove the depreciation expense. Why? Because depreciation expense is a non-cash related item. So it's an estimate of the allocation of cost. Therefore, when we think about cash disbursements, we would remove the depreciation for the selling and administrative expense budget.